Do you know what the most profitable fund in the world is in 2023? It doesn't buy stocks, it doesn't buy cryptocurrencies. It buys a very arcane financial product called a catastrophe bond. Are you trying to say something big about bonds? The catastrophe bond is the bond of catastrophe. Catastrophe bond. It's called a cat bond for short. In 2023, the return was 20%. Some people might think 20% is okay, but Bitcoin could go up 20% in a day. In the world of finance, you don't look at risk, you talk about yield. Isn't that a scam? Why else would you save in a bank? Buy all Bitcoin. You see, this is the approximate performance of US bonds in 2023, and this is the performance of catastrophe bonds. If you look at it, it's not just high yields, it's stable. Aren't you curious? What do you mean? Something with a solid 20% return. Is it some shady capitalist who comes up with a phony product? Let's see what a catastrophe bond is. In fact, the concept is very easy to understand. It is similar to you buy ordinary bonds. You will get some interest on a regular basis, will be returned to the principal at maturity. The only difference is that you're betting against nature, and when something big happens, it's a catastrophe, like hurricanes, floods, fires, earthquakes, etc. I'm sorry, but depending on the severity of the disaster, some or all of your investment money may be lost. Of course, what he means by catastrophe is not a very vague concept. Every bond is subject to very strict limits on when, where, and what kind of catastrophe it is. Let's say you have a bond that matures in 5 years, and if you don't have a catastrophe, you get a risk-free rate every year, plus 10%, and that's your yield. But during those 5 years, if there is a hurricane in Florida, like how much the wind speed is, or if there is a named hurricane that makes landfall in Florida, even if the disaster occurs, you will have to pay according to the terms agreed upon before. There is a high probability that you may lose the whole of the principal. What can you think of it as? You put your money in the bank and get 10% extra interest a year. But if there's a bad hurricane in Florida, you lose the money. This is a catastrophe village for a Florida hurricane. Now, this isn't just an example I made up. This is actually a very popular type of catastrophe town these days. Why? Because after the epidemic, many people actually began to telecommute. They moved out of particularly crowded places like New York to places like Florida, where the weather is pleasant. Every day is like a vacation to buy a house. So the whole of Florida, its housing prices are up. The supply of houses is also more. More people to buy insurance, and the biggest thing this place has to protect is hurricanes, which brings us to Hurricane, Florida. We'll get to that in a minute. There may be Asian fire bonds, Japanese earthquake bonds, New York flood bonds, and so on. A new category, called cybersecurity catastrophe bonds, emerged just last November, cybercat bond. That is to say, if a company is attacked by hackers, even if a disaster occurs, it is quite imaginative. I don't know how to define being breached. Let's see why someone would buy this kind of bond. That's very simple, because when there is no disaster, it does make a lot of money. I just said the Florida hurricane bond, I'm not making this up. But the risk premium is actually 10%. I looked it up, and the risk premium for this type of bond is usually somewhere between 3% and 15%. In recent years, it's been above 8%. Isn't that tempting? The probability of the disaster is usually between 0.5% and 2% per year, which means you only have to take a 0.5% to 2% risk of losing money each year, 8 to 10% of the excess return. Does that sound good to you? But you can intuitively think that his profits can be stable at this level of income. It is certainly not an ordinary people can play things. Indeed, he sounds so profitable that only a few highly specialized hedge funds are active players in the catastrophe market. But when we talk about these highly specialized hedge funds, their expertise is not mathematical modeling, quantitative hedging, but forecasting the weather and forecasting earthquakes. You think you need to be able to accurately calculate the probability of this disaster, so that you can know whether I should buy this bond, whether it is worth it, or even if you get lucky and get it right once or twice. But you need to calculate it for a long time. It doesn't have to be more profitable than your bank account. So actually, it's quite funny. That is, the hedge funds of the buyers of this catastrophe debt, their researchers are there all day long, studying weather forecasts, studying geology, etc. Didn't NVIDIA always claim that their AI chips were very good at calculating turbulence phenomena like hurricanes? I'll tell you that this kind of hedge fund bought a lot of graphics cards, and these hedge funds, they calculated the probability of these disasters. In fact, it doesn't mean that when I was about to buy this bond, I calculated, predicted, after buying up the bonds, they will hold them all the time. In fact, what they need most is their expertise is to predict the probability of future disasters in real time as the price of bonds fluctuates. To decide whether or not to trade the bonds in real time. For example, if a hurricane suddenly appears at sea and is slowly moving toward Florida, bond prices will surely plummet. The more likely it is to make landfall, the harder the bond will fall. Well, you think that as a holder of, say, a hedge fund, a bond, if you can predict the possibility of this hurricane before anyone else, and you find that by selling first, you can possibly avoid huge losses. On the other hand, suppose the market estimates that the probability of the hurricane making landfall is 60%, but you are very professional. After careful analysis, you feel that it is not that serious, then you can actually rush into the market to pick up a bargain, buy a lot of bonds. If the hurricane goes right from Florida, as you'd expect, just a little bit, and doesn't cause an actual disaster, then bond prices will come right back up. And you'll make a lot of money in the process. For example, when California is on fire, these fund managers may use all the resources around them, such as getting a satellite view to see where it is on fire and where it is not, to judge the size of the fire. Will it cause an actual disaster? Will it actually trigger a bond redemption? Anyway, I believe you should feel, this money he is not ordinary people can earn. The 10% excess, the income is not ordinary people can get. Speaking of which, some brainiac friends may raise a question. No, even if there is no disaster, it's excess, the yield is 10%. Why do you think this bond will have a 20% yield by 2023? Let me break it down for you. This is because in September 2022, the United States was hit by a hurricane called Ian. Ian became Florida's most destructive hurricane on record, racking up more than $100 billion in damages and triggering several catastrophic debt workouts. So after that, investors were a little bit scared. They felt that, is it global warming recently that makes this kind of extreme disaster more and more likely to happen? And the degree of this kind of disaster is also becoming more and more serious. They don't believe their original model a little bit. They don't even dare to buy this bond. So the price of the bond starts to fall. So the catastrophe bond market as a whole is actually going to be negative in 2022. Then in 2023, nothing happened. Not only did it not trigger any big payouts, but it allowed people to get their coupons, and the price of the bonds slowly came back up. That's about a 20% return for all of 2023. So in the beginning we said that 20% was a bit of a gimmick. It was also the highest return on catastrophe debt in history. If you look at the returns on catastrophe debt, it's probably less than 10%. It's certainly higher than the national debt, but it's definitely not 20%. That's an exaggeration. Let's look at the person who buys the bonds. If nothing happens to him, he will get a steady income. But if a disaster happens, he will lose a lot. What is that? Isn't it a little bit like he's offering an insurance policy, a major catastrophe insurance policy? Well, let's think about it again. Who will buy this insurance? In other words, who will issue this bond? That is, who will get paid in the event of a disaster? In fact, the insurance companies are the most important ones, because the insurance company would lose a lot of money in the event of a disaster. They would issue catastrophe bonds to hedge some of the risk. Another type of issuer is the government agencies of various countries. For example, the state governments of the United States, like the New York state government, once there is a flood that floods Manhattan, well, he lost a lot of money. So he might as well issue a Manhattan flood bond to hedge that risk. And the governments of countries with less developed financial markets, such as Mexico, Chile, and Jamaica, will ask the World Bank to help them issue some of these catastrophe bonds. So if you buy this catastrophe bond, you're insuring the insurance companies, or the governments, or the World Bank, and you're really good. Let's take a look at catastrophe debt. The whole chain, like us ordinary people or ordinary companies, we need to hedge some of the risks, so we go to insurance companies to buy insurance. And as a large part of the insurance companies, that kind of individual risk, it really can be smoothed out in enough quantities, like the risk of a car crash. Health risks, this is actually the basic logic of insurance companies. That is, they spread the risks among everyone through large amounts. But for this kind of catastrophe insurance, it's different. If there is a hurricane in Florida, half of the homeowners in Florida are going to have to pay for it. So who can afford it? For this kind of systemic risk, the insurance company actually cannot reduce the risk through a large scale, even if the insurance company has money. Right? Or the government has money, it can withstand the losses caused by this kind of disaster. But he may have to set aside a lot of contingency funds to deal with such rare occurrences. Well, in fact, this is also not economical for him. For example, if you are worried that your house may have a 1% chance of facing a disaster caused by a hurricane, can you put half of your family's assets in a bank account for a rainy day? That's not realistic. You'd ideally want to buy insurance. The same is true for insurance companies, which also need to issue some of these catastrophe bonds to hedge their risk or shift risk to the market. And investors in the market, they like this kind of bond very much. Why is the yield high enough in the first place? And in fact, a very important point is that this catastrophe debt has almost zero correlation with other financial assets. You see, the price fluctuation of catastrophe bonds is basically calculated according to the probability of the disaster coming. The probability of a wind-blown earthquake and the fluctuation of the stock market, even if they are not completely unrelated, and that hardly matters. Because this irrelevance is great for asset allocation, because if you allocate a portion of your assets to catastrophe debt, you can greatly reduce the volatility of the entire portfolio. In effect, you're helping investors reduce their risk. I introduced this theory in detail in the LTM issue. Therefore, by buying insurance, consumers transfer some of their risks to insurance companies, which in turn issue catastrophe bonds of this kind, and transferred some of the risk to a large number of investors. By buying catastrophe bonds, these large number of investors reduce the risk of their own investment portfolios. DOUC, with the help of this securitization, consumers, insurance companies, governments, and investors all reduce their risk. Notice the cost of these disasters. It doesn't go away. Your house gets blown up, and the damage is still there. Just say this catastrophe bond, it can let the whole market join together to help you compensate. What's the beauty of this mechanism? These investors are the ones who are the ones who are the ones. He didn't come to buy the bonds because they were morally superior. Just because he wanted to make money. You don't need to rely on their moral standards, and they are not there to make a fortune. They are the most afraid of the whole market inside, the people who don't want the disaster to come. You see, this bond, with its high yield, has attracted such a group of very professional people who spend all day there studying, saying, how high the debt rate is when a disaster happens, will something happen, and once something happens, they have to come up with their own margin to pay it off. Doesn't that seem like a reasonable division of labor? You simply listen to this community. The feeling may be out of Wall Street packaging out of a what colorful, strange products. It's exactly the kind of thing that Goldman Sachs built up in the early 2000s. But in fact, when we analyze it in this way, do you also feel that it is not like a financial product that is too complex for anyone to understand? It is indeed through the securitization of financial markets, through purely profit-driven adjustment of supply and demand to automatically allocate risks and benefits, to help rationalize the social division of labor. Isn't that amazing? That may be the magic of finance. If you enjoyed my video, don't forget to like, subscribe, and follow. I'm Cowboy, and I'll see you in the next one.